thank you everyone for coming today. Obviously, this was not a compulsory session, but it's a really good session because I think it's good for you to think about whether you want to register as a sole trader or a limited company and understand all the kind of implications around those two different structures. And we're delighted to have Ben Brophy, who has been a keen supporter of BC over the years. In fact, he did BC 10 years ago or something?
Yeah, just over.
Yeah, so just over 10 years ago. So he understands, I think, where you are, how you feel sitting in your seats now. But obviously since then, he's gone on to become a chartered accountant, and actually really excitingly as well, because this is kind of similarities to you. He's a couple of months ago left the comfort of his accountancy firm and has set up on his own. So he's going through some of the things that you'll be going through in terms of, onboarding new clients and that, and doing marketing and that type of thing. So, but it's a really good session. Ben's got a set of slides, but also the most important thing is that you get answers to any questions that you have before you decide what you're going to do. I think, is it better to take questions at the end? Yeah, probably better to take questions at the end, because Ben might actually go on to cover it later on in the presentation. So if anything occurs to you, just jot down your question. And there's no such thing as if it's a question you want answered, it's an important question. If it's don't, it's a very safe space here. So ask any questions that you want. And then afterwards, obviously after Ben's session, you can leave, or if some of you want to actually stay and register your business, we can be here to help you do that. We can walk around and talk you through it. And then I think it's 5:30, we've got a BC meetup as well. So we've just got some pizzas and some drinks and a bit of a social. So again, if you're free, you're more than welcome. Be lovely if you wanted to join us for that. So I'll hand you over to Ben. Thanks, Ben.
Thank you. So hi everyone, welcome. Thank you for coming. So obviously my name is Ben Brophy. As you just heard, I'm a chartered accountant. I've been a chartered accountant for over a decade. Working with practices, and officially the last 2 months I've set up my own practice, which was a long time coming. So I know a bit more of a refresh of what it's like to go back into startup mode. Certainly taking that kind of first leap is definitely not for the faint-hearted. So I think first and foremost, a massive congratulations to yourselves who are looking to make that jump. It's so easy to say I've got this idea, it would be great, and not actually take any action on it. So the fact you're here is a massive step. So well done to all you for doing so as well. So who am I? Obviously, first and foremost, we'll do questions at the end. And like I said, there's no stupid questions. Now, some of you here may have accountancy or business backgrounds. Anyone studying it at the moment? Yeah. Yeah, that's not bad for 50% or so. Obviously, the other 50%, if you don't worry. There's very few technical terms. Ones that I'll explain. You don't need to know finance and accounting. So let's do the complicated bit. Business owners, you don't need to be an accountant. So don't worry. And if there are any technical terms, just shout. Any technical bits. So there's a QR code. If you want to have me on LinkedIn. Great tip if you're B2B, LinkedIn is amazing for you. Highly recommend it. You'll be surprised how much work you can get out of LinkedIn. So definitely go that way if you're B2B. So yes, I'm a business owner, 10 years in practice. I'm a vice president of essentially it's a regional group accountant. So really exciting stuff. But it means I am working with accountants from Bedfordshire, Buckinghamshire, Hertfordshire, and obviously working with some accountants in Birmingham as well. Now, it's not the most exciting meetings I've ever been in, but it's good for myself. I was a Aston University graduate in 2014, so a long time ago now, and I was on the BC course as well. So hopefully I know a little bit about where you're coming from and kind of where you are, how you're feeling, and there'll be plenty of questions to go through at the end. So I work with startups and established businesses. I'll go to my favourite story. So one of my first clients was someone who called me on a temporary phone. They had a business idea, that was it. Their car got broken into. They literally had, I think, their mum's phone. 2 years later, they got valued an external investment for £10 million. Now, over 2 years from an idea to 10 million isn't the norm, but it just shows you how things escalate very quickly. So hopefully, you could be that next person. All it takes is an idea. So obviously, why are you here? Generally speaking, there's not been one thing, one goal, and that is to have an understanding of what business structure is right for you. You might be told you have to go company or pay or charity or benefits. So hopefully by the end of this session, you'll have a better idea of where you want to go. And some of you probably will have an idea of, I'm going to be a company, and you probably may not change your minds, but at least you've got a bit more background on why you want to be a company and how the next 18 months. Obviously, tax is a big one, and I'm sure you'll hear loads of things down the pub saying, if you do this, you can save X amount of money in tax. I'll go over some of the taxes. It's not to frighten you, just to give you awareness. Now, as a business owner, no matter what structure you do, the number one thing is you need to be aware of what's going on. So be aware of what taxes you need to pay. You don't need to know how to calculate it. You don't need to know how to do it. You just need to be aware of it to get an accountant, or to keep yourself out of jail, in short. And you can focus on what you guys do best. So we'll go through pros and cons as well. So first and foremost, there's kind of 4 main structures. I do have an extra slide on the charitable side. So don't worry if you are thinking charity, CIC. Anyone going down a community interest or charitable side today? Yep, perfect. So we'll cover that. Everyone else, you're all looking to make loads of money, retire, go to the beach somewhere to live out the rest of your life in 5-10 years. Good. It's quite a bunch today. I'm not a lecturer. You can say what you think. So first one is a sole trade. So sole trader is yourself, first and foremost. You can't have more than one person sole trader. Essentially, if there's 2 of you, it could be a partnership, could be a LLP, or a company. It's just yourself. You have the option to be a sole trader. You can't be a sole trader if there's more than one of you. Now, as a sole trader, if I start with sole trader first, obviously you can still employ people, so you can be a sole trader and still have lots of go. And then taxes. So this is the complicated bit in terms of terms. If you're not from accountancy, finance, doesn't matter. It's just different types of taxes. HMRC will tax you whatever way you go, so you don't need to worry about that. Essentially, you will do a self-assessment tax return. Most people just call it a general tax return. So any profits you make as a sole trader, you will get taxed on that. Same as any other way. Now, the big bit I was going to talk about is, we call it liability. Essentially, some people see it as risk. So as a sole trader, the sole trader is you. You are that business. You take on all the profits and you take on all the risks. So if someone decides to sue you for something's gone wrong, they are suing you personally, your business. Depending on the industry, that may not be as much of a worry. If you're photography, unless you do something dramatic, it shouldn't be as risky as, say, food or chemicals. So if you're dealing with chemicals, there's a lot of risk there anyway. And yes, there's insurance, but generally there's an extra layer of protection there. Now, a lot of people say, well, do I need insurance if I'm a company? So it's not linked to me personally. Yes, completely, you still need insurance. It's just separating it. So as a company and an LLP, so other side of the line, you can treat that as its own entity. So if you want a nice fancy Tesla because it's nice and tax efficient, maybe not these days, maybe a different fully electric car, the company can buy that car, and the company is the person on the contract. Same with LLP. Whereas the other side, if you're a sole trader or a partnership, it's you or both of you. And that's the best way to look at it, is who's actually going to be on the name of the contract. If you're buying a car or a property, if you're a sole trader or a partnership, it's you personally. If things go wrong, it's you. If it's LLP or a company, then that's what's on the contract. Now, if you do something really bad as a company, yes, you're still going to be in trouble. They can still come for you as a director. So, for example, if you're a chemical company and you put no health and safety in, and there's hazardous chemicals everywhere, everyone's getting injured, then clearly, yeah, you're still going to be in trouble. It's not a complete safety blanket. So this is the really complicated slide. So don't worry too much, and don't worry if you have no idea what LLP actually stands for. Now, out of interest, so there's quite a few of you in finance and accounts. Who knows what LLP is? No. Cool. Yeah.
Okay. Is it the same as a limited company?
Kind of. It's a lot closer. So LLP, and I will go over this in pros and cons. LLP is, I call it this new kid on the block. In terms of company formations, HMRC, it's still fairly new. It's essentially a partnership, but you've got the benefits of the company. Now, it's not that common, but you'll find solicitors, accountants can be LLPs. So you'll see it in certain industries. So it's like a partnership. You get taxed like a partnership, but actually you have a little bit of protection where the LLP can get that electric car, not you personally. So this is just the overview, and we'll be able to kind of break it down. Now, very quickly, just for the other side, obviously charity CIC we'll go over as well. So it can be just yourself, it could be more than one person. You don't have to be the sole person of a charity or a CIC. And I'll explain what CIC is. Again, yes, you can have more than one people in it. You don't have to have everyone as the owner. Taxation, obviously charity gets taxed a bit differently. CIC is quite complicated, and if you're not into it, you're probably not interested in it, but you can potentially get taxed through corporation like a company if you're not careful. And then obviously that limited liability, the risk factor, obviously it's limited, but again, doesn't mean you're never going to get in trouble. I mean, that's the best way to kind of look at it. So now we've got over that kind of complex grid of sole trader employees, who can be what. Just wanted to go through pros and cons just to break it down a little bit. So sole trader, it's you're an individual. There's no legal difference between you and the business. Like I kind of said, you are that trade. So if you are window cleaner, it's you as the window cleaner. It's not your company. You're the same thing. So sole traders, actually really easy to get started. It's not that complicated to set up, expensive. You do need to go to HMRC and say you are set up as a sole trader. You can't just assume that they'll know that you're a sole trader. I think that's one of the big things, is actually people just assume, well, I'm gonna just start doing it, I don't need to tell anyone. Unfortunately, you will need to tell HMRC, otherwise, they will find out at some point and you'll be in a whole heap of trouble. So as a sole trader, you get to keep all the profits. So whatever you make, that is yours. If you've got 100 grand sitting in that bank account. That 100 grand is your money. So obviously fantastic. You don't have to muck around with complex ways to get that money out of the business. Obviously cons, like I mentioned, won't go on it too much, but unlimited risk. If you're a chemical company, perhaps sole trade is probably not the way for you, because of that unlimited liability risk. And similar to a partnership, obviously sole trade affects you if you die or you want to perhaps join another person. That sole trade finishes. So if you are a sole trader, okay, of course they're doing a similar thing, and you're like, let's get together, make something work. There's a saying, 1 + 1 = 3. Sometimes, so if you've got two businesses coming together, you make extra value working together. That probably confuses everyone that much more, but added value. Obviously, if you've got two sole traders coming together, both of them finish. That is it. Now, obviously, you can carry on that name, so you get a bit of brand awareness still. But it's just to say, what you do, the business, sorry, is you. If you finish or change, that's finished and changed. Yes, get a similar name and carry on, but that is the end. Raising capital, sole trader. Now it can be difficult. So if you're trying to get external investors as a sole trader, it can be a lot harder. Simply because there's nothing for them to keep hold of. So if you're a company, you have this pizza pie. You can say, here's 25% of my company in return for some 100,000 safely. You can't do that with a sole trader. The best bet you're going to do is put your house on a line or any assets. So if you are looking for external financing, funding, investors, sole trading could be a lot harder to do because you don't have that leverage. It's a partnership. Very simply, it's two sole traders come together. So you've got the same benefits and the same cons there. And now the only thing I'd say is, obviously, working with friend, family sounds great. People fall out, and because it's so easy to start a partnership, I'd say get the ground rules or an exit plan in place from the very beginning. If you go, a lot of people don't actually have the conversation of, are we 50-50? It might be one person is chucking loads of money, and you say, oh yeah, we'll do a partnership. Well, if someone's put 10 grand in and the other one's put nothing in, what's going to happen at 10 grand? Is it just, it's been swallowed up? Are you expecting it back? Or are you expecting it to be 60-40? So set out, ideally written, even if you're best friends, family, whatever, this is the split between us. It's 50-50, and have a chat of how do you want to exit. In 5-10 years, hopefully, how do you want to exit? Is it, or do you want to exit? You might have different views of one person wants to do this for the rest of life to retire. Other ones thinking in 10 years, I'm going to sell and move with something else. It's good to have those conversations now, because otherwise it can get messy. And it is surprisingly common, really common in fact. So LLP then, so this weird, wonderful thing that you don't really see. So if you are in a certain industry where you see LLPs, so accountants, lawyers, great, fantastic. It's the same as a partnership, but you file your accounts online. So on Companies House, you can go online and find some accounts for them. You've got that little bit of protection or limited liability, which is obviously great. Same as a partnership, you must have more than one member. So you can't, as a sole trader, go, do you know what, actually LLP sounds great, to be that. You need more than one person or one member. And if it can be more, so partnership doesn't have to be 2, could be 3, same with LLP, could be 100. There are LLPs out there that have hundreds of members. Now, whether that's the right structure is debatable at the moment. When you get to that level, that's a problem for later. But for you guys, if you go down that route, I guess. If someone exits the LLP, you must have more than 2 members or more at all times. So if you start an LLP and someone exits, then you need to find someone else, or you effectively can't be an LLP at that point. Now, before I move on, I just want to touch on this element of what you can see on Companies House. So LLPs and companies, you can submit your accounts each year, and something appears on Companies House, and it's your year-end accounts. Now, if you Google the likes of Sainsbury's, Tesco's, you get a massive heap of information. You get a P&L, balance sheet, loads of 40, 50 pages of utter, I was going to say utter crap. Normally you only look at the first 3 pages, the figures, but you get the whole heap of information. Now, that's great, but that's for a company, so it's a public company. Now, if you look at a private company, which you will be, you're not going to be listed, well, someone will be soon, but you won't be listed on the FTSE 100. You're going to be a private company, you own the shares. What people can actually see is very limited. So you'll see a balance sheet. Now, from there, very few people are going to be able to look at it and say, oh, this is how much profit they made, this is how much income they are taking home personally. People get scared. The fact that someone can go in and look at their own company figures. Just start having to Google some companies who are private, not public. The information you see is very, very limited, and hopefully that will reassure you. Because it's a question that comes up of, I don't want anyone to see how much money I've made or what my salary is. From what you can see on on Companies House, that's not the case. So, limited company. So again, you've got limited liabilities as a risk factor. It's great. So you've got investment opportunities. So what I mean by that is a company is owned by the shareholders, and this is quite an important piece. So the default generally is 100 shares. It doesn't have to be. It can be 1 share, 3 shares, 1 million shares. I think someone on Companies House has, I think it was 1 billion shares. I think it's got taken down now. Rules are changing, but you can do whatever you want. Now, 100 is quite standard. And because you get 100 pieces of buy. Now, at the start, you may own 50%, 100% if it's just yourself. Fantastic. You own that bit of company. You may not be the director as well. From the beginning, all of you probably going to be the shareholder and director. As things go on, you may not be the director. You may get someone else to run your company in the future. You're still the owner as a shareholder. Now, what happens is people start giving away shares. So if I turn around to you and said, hey, website, it's going to solve all your problems. It's going to cost you 10 grand, but I know you're a startup. So let's just say, give me 3% of your company and I'll do it for free. Sounds great, right? Don't have 10 grand lying around. They've now got 3% of your company. And let's just say, you're the next Gymshark. 5 years later, 3% of Gymshark is a lot of money. So be careful. And people will, friends and family will even want to try and get in on the action if they've got an idea. Treat the shares like gold dust, because it may not feel like it's worth it now. See, 5 years time, it could worth a lot of money. And that's one of the hard bits of investment, is actually valuing a company. If you've got a business idea, I could say your company is worth nothing. You might be thinking, that's insane. The idea alone is could be worth 500k. So really important point. Obviously, if you give away all your shares, then you're not the owner of the company, but you may still be a director. The director is working for the company, i.e. the shareholders. So you may get someone in as a friend to say, look, come in, run the business with me. You'll be a director. Yep, fine, great. They can do a good job. They don't own any of that company. In reality, you're probably giving them a nice salary as a result. But it's important to kind of know the difference. Now, the last bit I was going to mention is something called R&D tax credits. So who is doing something tech related or innovating, doing some brand new process, never been done before? I've got you. Yep. Any others? Yep. No, no one else? Tech, innovation? No. So R&D, and to give you an idea, one of my biggest clients that did R&D was a farmer. So R&D normally, stereotypically, doesn't have to be. So if you're doing something new, a new process, it doesn't have to be successful. In short, you can write to HMRC and get a tax credit from them. The government want you to be doing research and development, and you will either get hopefully a nice tax or a tax deduction. So potentially, if you spend, let's just say 50k on salaries developing your new software, you're doing it all in-house, it's brand new software. HMRC may look at it and say, yeah, it's R&D, here's a nice check. We've cleared down all of your tax, or you've got a nice cash refund. Keep doing what you're doing. It's a massive thing to look into. Like I say, with the farmer, what he was doing, he was working with football clubs. So the ground with football club has to have a certain dense of a mixture of sand, dirt, and whatever else. And actually that compound and that mixture hasn't been done before. It gets really technical. But they were able to claim R&D because they're doing something new and innovating in their own sector. So you don't have to be this tech startup with to get R&D. So if you are starting and doing something new or innovating, at least have the conversation, because it's probably one of the best benefits you would get from the government. And that can only do as a limited company. So some of you are doing a charity or CIC, some of you may not be doing it now, but as you grow, you may decide to be very charitable and have a charity on a site because you're so successful, which is surprisingly not uncommon. So obviously the core purpose isn't for profit making. You're not out there to make loads of money. You're out there to make a change in the world. There are grants, there's tax reliefs. Being a charity and actually saying this is what you're doing, you can get the grants, you can get credibility. Now, you could do exactly the same thing as a charity or CIC, doing good in the world as a sole trader or even a limited company. You're not going to get as much credibility or as many grants, because if they see a company, they think, okay, you're out there to make loads of money. No, it may not be the case. You may be generally out there doing, a lot of good work for various charitable activities, but actually just looking at the structure, people get turned off. And that's probably a good point for whatever options you take. Now, I can't stand here and go around and say, right, you should be, company, you're definitely a sole trader, you're an LLP. What I can say is look at your industry. So if you're a photographer, for example, have a look at other photography businesses. A lot of them sole traders. If a lot of them are, then it's a bit of an indication to say, actually, this may not be a bad idea. Now, obviously, that may not be best suited for you, but it's a good hint. Is anyone in doing photography? No, good. I use photography as an example quite a lot, so that's fine. I'm not going to upset anyone. Right, so charity then. If you are thinking of doing good, obviously there's a number of regulations, of rules to follow. Given the trust you put into a charity, you need to make sure that you're following it. Otherwise, you're going to cause yourself a lot of issues with the regulators and in short, so CIC, what does it mean? Just to cover up the charity aspect. So community interest company. So again, I kind of look at it like this LLP. It's a bit unusual. People don't always see it. Now, the best way to explain it is you have your nice big charity, and you'll have quite often the charity shop that's established down on the high street somewhere. Now, the charity shop may well be a CIC, so they can make a bit of profit, but with the purpose of shifting it to the charity. So it's a bit more of a entrepreneurship way for charities to gain a bit more money. They can make a profit, they're allowed to make a profit, but the core purpose of the charity, of the CIC, is to give money to charitable activities. It's just a different route to do so. You're still going to have a number of rules and regs to follow. So it's really important that you look at it carefully. And actually, community interests are becoming a lot more popular. So I've spoken to quite a few of them over the last 6 months around Birmingham and London, where they're working in the community. So one of them, I think they're in London, are doing a lot of projects to clean up the local area, clean up the community, community vegetable, for example, or community path. A CIC's given them that flexibility to add a little shop on it and say, okay, we'll sell some of the like produce or sell gloves for people to do the big cleanup, and profits we make we can kind of put into the charity. So that's the options, and I will come back for questions at the end, so I'm not sure you're going to have a ton of them. Now I've got a couple of slides just for the taxes. So this is where everyone gets really confused and it's scary. Everyone has to pay tax. Loads of different names. Don't worry. I'm not going to go through the finer details of these. Obviously, you'll have access to the slides and you can message me as well if you need to. Essentially, am I going to get taxed as a director? Yes. Director of a company. You are probably going to be on a salary. So if you've been employed, you get tax PAYE, NI. You see it's a nice big number at the top of your payslip and then a tiny number at the bottom. Everything in the middle is all the taxes you pay as an employee. As a director, being paid as an employee, same happens. There's something called dividend. So as a company, as a shareholder, this is where director shareholder comes into play. You can take money out a different way. Generally, in the past, those with background, if you've got family in business, they'll say, "Oh, I've got a salary of just £9,000, but I take out 100k in dividends." That's a typical kind of way businesses or companies used to work, of small salary, high dividends to take money out. Now, you don't need to worry about any of that. You'll get an accountant to advise you and do it for you. All you'll need to know is, I need X amount of money to live off, and that's going to be my take-home pay, and they'll be able to sort the rest. So when someone says, what salary you take, what dividends you take, it can feel quite overwhelming. You don't need to worry about it. Talk to your accountant; they can sort it out, because they can get quite confusing. And you don't need to worry about, how do I pay myself? How do I do a pay slip? That's stuff other people can do. A pay slip, for example, can be as little as £7 a pay slip a month. So why would you muck around with trying to figure out, how do I do payroll? Oh crap, I've done my friend's payroll wrong, and now he's got paid too much tax, and he's moaning because he can't afford anything this month. It's got an entire overdraft. It's not worth the risk. There's a number of things. Even I don't do payroll. I have a payroll team that do it. It's just not worth the risk. So if you are going to employ someone, outsource it basically. So if you're a sole trader, well, do I get a pay slip? No, you get all the money, and then you do a self-assessment tax return once a year, and then HMRC will tax you at the end. Now, it's important to know that bit, and it's the same as dividends. If you are taking money out and it's not through a pay slip, you are going to get taxed, but you're going to get taxed in one big lump sum at the end of the tax year. So what I normally say is, if you're making money and you make a profit and you're taking it out, set up a separate bank account and put 20% away, for example, once you get going. Because when you come down a year later and you've took 70k out and your tax bill was huge, but you haven't accounted for it, can be painful, especially the first year. The first year, the self-assessment as a sole trader or individual through dividends, you can effectively almost get taxed twice as a kind of a catch-up. You pay up in advance. So if you are lucky enough to make decent money, be really careful on that first tax return, because it can hurt. And that's one of the things I have to deal with a lot, where actually someone's earned loads of money, they've took 70k out, but actually the tax on the 70k isn't just it. These are a bit upfront for the next tax year as well. And that's a lot that people catch out. Now, again, you don't need to necessarily know this or how it all works, but the underlying messages, especially if you're sole trader, and your accountant can do a bit of tax planning and say, look, this is how much 6 months in, this is how much tax you'll have to pay, and you can say, right, stick this into a instant savings bank account, whatever you fancy, or oh crap, I need to start saving some money now. So again, not going to go through all of this because it will overwhelm a ton of people, even myself. VAT. So VAT, you're expected to hit 90k in income, you will have to register for VAT. And the big thing I'd say for VAT is, what people don't think about is, if we are customer to customer, you're selling a product for me for £10 a product, a widget, it's going to cost me £10. You hit 90k and say, right, I am now back registered. I'm as an individual going, great, well, what does it mean to me? Actually, you've got two choices. I'm not registered because I'm a customer, I'm an individual, I can't reclaim that back. So either you're going to give me a price increase or you're going to pay HMRC 20% of your profits. Because you're paying me, I'm buying a product for you for £10. Now your net is always going to be £10. The moment you are paying in VAT, you've got to put extra 20% on that, because you've got to give 20% of what you receive as VAT to HMRC. So it's a good thing just to keep in mind. Once you're hitting that, hopefully everything does really well, you start making money, and 50, 60, 70k, you need to start be thinking, right, what about VAT? And then you've got decisions to make. Am I going to give everyone a price increase as individuals? Now, if you're business to business, they won't care because they're reclaiming that anyway. They can, so they will just reclaim the difference. And that's just one complex area that businesses never think about, is actually from a VAT perspective. Once you get there, I'm hoping everyone gets there, that's a good problem to have, is how does that affect your price? Now, obviously, when you get to 50, 70k income, you have a chat with an accountant and I'll be able to guide you through this. But it's a good, well, one, it's a good problem to have, and then two, it's good for you guys to know about it now, so you can think, crap, that guy said something about hit 70k, speak to an accountant. Then obviously you have a look at it and have a plan. Payroll, kind of talked about it. PY, NI, basically, if you are employed, you're gonna pay tax, and it's the same for employees. If you want your friend to work with you, you are gonna have to register him as an employee. He is gonna have to pay tax. You can't just say, here's a couple £100, well done, thanks for the work. It needs to go through HMRC. R&D tax credits, we've kind of already spoken about. Corporation tax, people hear a lot in the news that corporation tax is 25%, or I got taxed 26%. It's a marginal scheme, so the lowest you can get taxed is 19%. You hit a certain threshold, and it goes into this weird calculation, and you end up at 25%. Now, if you're paying 25% corporation tax, you've got, well, you're doing very well, and that's probably the least of your worries at that point. So generally speaking, if you're making at least 50k profit, you're probably still going to be paying 19%. You're not going to be paying 25, so don't worry. When you hear you make that down the pub say, oh, why your company, you're paying 25% tax and everything. It's a massive because it's quite a complex formula. A lot of people are throwing around really random numbers. So don't worry. If you hear anything like that, speak to your accountant. They'll be able to help you out. I think that's probably about it. Obviously, tax deductions. We'll probably have some questions at the end about what. Now, general rule of thumb is keep your receipts, because HMRC do random investigations, and it is a massive pain in the backside. It really is time consuming. They'll pick the most random stuff and they'll ask for invoices. Now, if you don't have a receipt, you've then got to hope that it's in your company bank account, not your personal, because then you're in a whole heap of issues we'll come on to in a second. But you need those receipts for proof. So keep all your receipts, put them in a software, or if you're just starting up, keep them somewhere safe. And it has to be business related. Now, for example, a laptop or phone, great. It's a business. Get the tax deduction. If you're VAT registered, claim the VAT. Yes, there's going to be some personal on it. HMRC know that, they allow it. If you need that nice new suit because you want to win your deal, that's where it gets complicated. You can't get your suit because there's a dual purpose. So it can be quite complicated. And if you are looking to a lot of people with companies, for example, get fully electrics. It's really tax efficient to do so, rather than getting a car themselves. If you're thinking anything like that, or you heard a friend say you need to do this because you're going to save loads of money, you can get it through your company. Just have a chat with someone first before doing it. I've seen the weirdest stuff that people try and put through that clearly isn't going to happen, and it sounds out like a sort of fun. I mean, we've got, it's not the weirdest, but one of the most obvious. We had a Peloton during lockdown go through a company, and it was a work from home. The Peloton got delivered to the home address. It's never left the home address. Clearly, that's not strictly for business. So sadly, I can't blame that. And it's now always in that business bank account. Really quickly on bank accounts, no matter what you do, please get a separate bank account to your own personal one. Whatever you do, sole trader company, don't mix them. 2 reasons. The first one is if you ever get investigated and they see you've got business stuff going into your business or vice versa, you'll open them up to investigate you personally, and they can go through your whole personal affairs. It's going to cause so much a cost for you. Now, you may not be hiding anything, but the cost involved once you open up the personal is huge. And actually, if it is mixed, it's really hard to prove that this is purely business. So make sure you have a separate bank account. Now, there's a couple of new rules coming out at the moment. You probably would have heard of MTD, making tax digital. It's happening for companies. It's now happening for sole traders. So you'll hear a lot more about this if you haven't already. Essentially, if you're a self-employed person or you are self-employed, you are essentially going to have to submit quarterly to HMRC through software. Now, the current plan is by 2028, that income threshold is going to be down as low as £20,000 a year, which I think is crazy. If you think someone earns 20 grand a year, they're now having to pay for 0, for example, or accountancy software, they need to pay someone to submit it quarterly and then still do a final return. So a lot of work. Now, if you, in your first year, hit 60k income per but this time next year, you are going to have to start submitting quarterly anyway. So it's a big factor to consider because historically, I'm a sole trader. I do a self-assessment tax return by myself once a year, and job done. It may cost me 150 quid a year. Company really fancy about to do some big year-end set of accounts and that's digital. A sole trader is going to have to submit quarterly, and HMRC can see bank interest. So a big thing is when you do your self-assessment tax returns, personally, please say what your bank interest is. And it's got so many people out. Actually, people are starting to make money through interest now. And if you don't declare it, they'll just investigate everything from you. And it's nice and easy to say, even if it's 20 quid for the year, just saying you've got 20 quid in you're telling them something. If I see a personal tax return and the bank interest, you've got personally a zero, especially if you've got a company. I'm going to do this is CREP to be PG, and HMRC are probably going to think the same, and they can. I'm assuming there's a database because they can see it, and we've had letters come through to say, we know you've got bank interest or pensions, whatever else it is. So they can see a lot more, and obviously with Make a Tax Digital, they can see more. So it's something that's quite current and new. So again, just extra factor to have a look at is making yeah, have a chat with people around BC. It's a consideration that is very new at the moment. So kind of wrapping up before questions and answers, the key considerations. What should you be thinking from your decision? What is your risk first and foremost? What industry are you in? Who thinks they're in a risky industry? Little hand in the air. Yeah. No one's gonna like this waving it around like crap. I'm in a massive one, so that's good. Number of owners. Is it just yourself? Is there 2 of you? Is there 5 of you? Are you all going to be shareholders, owners? Is someone an employee? They just want to crack on and do the work. Fantastic. If there's more than one of you, clearly you can't be a sole trader. Maybe a partnership, maybe a company. Who knows? Growth. If you are thinking of high growth, what's your end goal? You want to start a business. Then actually get an investment. Maybe a company is a good idea. You can get that investment, you can sell it. As a sole trader, you can still sell your business, of course. Actually, it's a lot harder. What's your core focus? Is it profit? Is it the community? Charity? Is a factor? Compliance. I think compliance these days, I wouldn't even really consider it too much. If you go company or sole trader, I think these days the compliance is near enough the same. So as a company, you have to file year-end accounts. There's something called an annual return and potentially a VAT return, depending what threshold you are. Now, again, as directors, it's your responsibility to know that they exist and essentially get someone else to do it for you. I certainly wouldn't recommend doing your own accounts and annual return. Annual return isn't that bad, but it's your responsibility, even if you hire an accountant. So if you say, do my accounts for me, here's some information. Oh, sure, I've got to tell you, I have a business trade that's got hundreds of thousands of pounds. It's still your fault, and HMRC will come after you. R&D, if you're doing something new, innovative, brand new process, doesn't have to be tech, then think of R&D, think potential company. And then reputation. So rightly or wrongly, depending on the industry, some people see companies as this bigger beast. So if you see a company, you automatically think, you know, they must be around for years, or they're really relying on them. Actually, it can be the exact same business as a sole trade. There's no difference whatsoever. Just some people see company in a certain way, rightly or wrongly, and that can be industry based. So, you know, for me as an accountant, if you saw a self-employed accountant, you probably would run to the hills, because it makes no sense for us with all the risk. But again, coming back to a photographer, actually there's very little risk, and most photographers are likely to be self-employed. Don't have to be. Yeah, it's a lot more kind of fitting. So have a look in the industry and think about credibility, if that is a big issue in your industry, right here only. So just to kind of summarize and close up before Q&A. So my own kind of closing thoughts: shares, really treat them carefully. I've had so many issues where someone's given shares but not updated a company's house to say they've actually done so, and then they make loads of money, and all of a sudden that one person is in a lot of trouble because the company they got given 50% in doesn't exist on paper, and they're now worth tons of money. Now legally, you look at work and it says you don't own any of that company, you've done all that work for nothing. And even if that doesn't happen, it can cause you loads of issues. So I've got one client who's notorious at this, in that he will set up a company, lets himself down, he'll work with a business partner, the company rockets, and then we turn around and go, crap, you didn't actually put the other guy in, did you? No. Now the company's worth loads of money to shift and give him the other 50% of the shares. They have to pay loads of tax, lawyers, all these fees, just to give the other 50% to what they should have done a year ago. So just be careful, make sure you get the paperwork right. So company's house, if you bring someone in, put them in straight away. If you're the 50% of the business, you let the other person set it up, just make sure they've actually put you on there. It sounds crazy, but it happens a lot. Cash is king, especially for yourselves as startups. No matter what your accountants and software may say, may earn loads of money, cash is the thing you need to keep an eye on. You can make loads of money until go bankrupt. I would say for the first 2 years, it's probably the biggest thing you need to look at is how much cash do I have. You know, ideally, you want to be in a position to say, I can pay all my costs by salary for the next 3 to 6 months. And then anything else, yeah, great. Some, you know, reap the rewards, take it out as dividends, salary, whatever. Go buy yourself a nice fancy car, but cash is so important. And a lot of the accountancy softwares will not show you that base. Show you nice big but actually, cash is the most important thing. So bookkeeping, get receipts, keep them. You need them. You want to claim the money back. You want to get that tax deduction. Really important. Be careful what you claim. It needs to be wholly for the business. There are some bits where you think actually that must be purely for the business. I'd never wear a suit outside of going to a meeting. No, that still is not enough. So you have to be a bit careful. In terms of bookkeeping, my own personal opinion, as much as it causes me pain for the first year or so, depending on how many transactions you have. If you've got, 20 transactions a month, are you going to be paying 33 quid a month for a software like Xero or QuickBooks? You need to weigh it up. You could probably get away with doing an Excel. Now, if you come to me and you're on Excel and you're doing 200 transactions a month, I'll probably cry and tell you where to go, or charge you a humongous fee to do so. So do go to a software fairly quickly, or you can kind of get away with it. If you're just starting up, it's only a couple of transactions a month, 10, 20, 30. Yeah, there's a cost saving to be had to weigh up. Obviously, I'm not suggesting at all that you don't use one of their softwares, but to weigh up for yourself. Deadlines. If you miss a deadline, you will get fined, and chances are you'll probably get charged interest as well. So do keep an eye on your deadlines, especially if you're not getting an accountant straight away. So many people, I mean, I've just done a tax return this week for the prior year. That should have been in last year. Now they've got a £2.50 tax refund, but they've got 500 quid to pay just in fees, penalties alone. And that's on like the smaller side. Now, if you had loads of tax to pay on top of that, that could be a huge figure. So do keep an eye on penalties, deadlines rather, otherwise you are going to pay penalties. No one likes paying tax, so why would you pay HMRC just for the sake of it? Yes, speak to an accountant, but get an idea of what your deadlines are, because at the end of the day, it's going to be your responsibility. You don't need to know how to do it, just, hey, I need to do accounts by the end of this month, what's going on? Because you're the one who's going to be paying it, not the accountant or your friend who's doing your accounts for you. You can change structures in the future, so it's not too uncommon for someone to start as a sole trader and then they grow and think, actually, things have changed, my business model's changed, I want to be a company. Yes, you can do it. It's not too common to go the other way, but it can be done. You can go company to sole trader. It's not impossible. So don't worry too much. You do come down to it, think, actually, I want to really do this. Yeah, I'll try something that can help. So accountants is a bit of a weird one. We've got the ones who use a lot of tech, so it's a lot more service based. You generally pay a monthly fee, and it's almost like a retainer to say, I'm your accountant, call me when you need stuff, and yes, I'll keep you out of jail. Not as a promise, but if you do everything right, we'll keep you out of jail and we'll get all your filings done. Then on the other side, you have accountants who will say, your accounts what's this? Great. You got a nice cheap set of accounts. You pay it all in 1 year and you're on your own. So do have a chat with your accountants when you start looking for them. How are they going to act? What services are included? Because actually it really varies. Some people, and it's quite rare these days, but you can't call them. If you call them, you're probably going to get a nice invoice at the end. So do keep an eye on that. And actually, a good accountant can save you a lot of money. And actually, I took on a client 2 weeks ago. I've covered my fees and tax savings for like the next 15, 20 years from that, first week. So a good accountant can save you tons of money. A bad accountant can often cause you to pay more money in short. So do find the right person, especially as you're growing. Yes, a friend might be able to do your first set of accounts. Yes, he could probably get away with it and get it done quite cheap. As you grow, that could cause you a whole heap of issues. Again, that client, he had someone else do his accounts and they overclaimed, I think 30, 40k. And if they got picked up on that, they would have got absolutely hammered. That effectively incorrectly claimed £40,000 from HMRC. Now, if you're HMRC and they pick up on that, that's not going to look good, and they're not going to be too pleased. I think that's it from me. So, obviously, first of all, thank you for listening, because it is a bit of a information overload. And even if you are studying accounting or in finance at uni, or you've got friends who do business, hopefully some of that made sense. Now, hardly anyone in the room has probably had enough kind of experience to know everything on there. It's a lot of information, so don't worry. And even if you have no experience, no one's started a business, it's completely fine. You don't need to know this stuff. You've got these slides and you've got people around you. All you need to know is what structure you're going to do. I wouldn't stress about it. If you have any questions, speak to me, speak to someone at BC and they can help you. Don't worry too much about, dividends tax is like 8.75% when there's come, you know, X and Y. You don't need to worry about that. You'll get people, friends who think they know a bit about it, and they'll tell you you need this nice group structure. I had someone last year, not here, somewhere else, was telling people what you really need is a nice group structure. You need a holding company, subsidiary, company in America, company in Ireland, company in Switzerland. Yeah, don't listen to them. You know, it's people make it really complex, and generally, if you hear some advice from someone down the pub, I can use that term loosely, but if you hear someone from public say, do this, it will save you loads of money, chances are illegal, and they're going to be caught out eventually. Obviously, very last thing for Q&A, good luck on your journey. It's a really exciting time. It is a whirlwind. Setting up my own business has reminded me how much of a whirlwind it is. 1 minute you're crying, thinking, oh my God, what am I doing? Next minute you're thinking, oh my God, I'm just, you know, twice as much money I would ever earn in employment. It's a roller coaster, but I absolutely love it. I'm sure you guys will do amazing. So, without further ado, no question is stupid. I've heard all sorts. Raise your hands and yeah, Q&A. Shout out what